want to say thank you all for coming back and joining us. We had some technical difficulties last week, and we always at Hennigan Realty want to make sure that we provide the utmost customer service. So that means virtually and also in person. So with all that being said, I am not going to waste your lunchtime with talking about stuff that does not have to pertain to Divvy that you guys came for. And I'm going to jump into introducing ourselves, and then I'm going to bring in our guest, Marlene, with Divvy. So go ahead.
Hello, everyone. My name is Roland Hennigan. I am the other half of the Hennigan Realty Group, and we are pleased that you are here joining us to learn all about Divvy. And I hope you can get some really good information that you can use, bring it back to us, and we'll get you in those houses if it fits.
Yes. And so let me formally introduce myself. My name is Dayna Hennigan. I am the other part of Hennigan Realty Group. And ditto to everything that Roland said. We have different programs that we work with. And we know that all programs are not for everybody, but we always want to make sure that we provide as much information. And we are here to consult with you all to help you to figure out what's the best way for you to go in towards home ownership. So with that being said, we're going to bring in Marlene with Divvy so she can introduce herself. Hey, Marlene. Can you see the comments on the side right here coming on? Okay, great. So as they come up, then we can answer them, but we'll keep the conversation. We have questions already pre-written, so we can kind of keep the conversation going. All right. So with that being said, if you don't mind, Marlene, just kind of giving us an overview of what is Divvy. We know it's a lease to own program, but what does that really mean, lease to own?
Kind of giving us an overview. Yeah, sure. Happy to give an overview. Everyone, great to be with you today. Just so you guys know, I do work with all of our Texas agents. So I work closely with Dayna and her team, and just making sure that they are prepared to work with you all as her clients. So yeah, in general, the types of clients that we typically work with are those who are potentially not mortgage ready at the moment, but those that may be working towards that goal. And so really the goal with Divvy is to give clients the option to rent a home while they're also working on savings at the same time while they are renting. And then giving you guys as our clients the opportunity to buy the home back at the end of the lease term. And so the really wonderful part of Divvy is that you have the option to purchase the home prior to that 3-year lease, and can definitely do that, at your will. So I would say some of the focal points of Divvy are that really we work with clients who may not be traditionally approved for a mortgage. We work with clients too who are really working on building towards that home ownership opportunity. And so we take a lot of pride in the fact that we do essentially force clients to save with us on a monthly basis. A portion of your rent goes towards those savings. And it really allows for you guys to have something built up when you are ready to do that buyback. So I would say those are some of the really great parts of Divvy. I would say another piece that doesn't necessarily always get emphasized is that we do report all of the rental payments on a monthly basis to the credit bureaus. So we have folks who, maybe didn't qualify for a mortgage based off of credit. Divvy's really great in being able to provide that as an additional benefit to working with us because those monthly payments help build your credit. And those are going to be really important when it comes to actually receiving a mortgage when you're ready to buy back from Divvy.
So I'm sorry, because there's a delay in there and we're listening to you on 2 different computers. But let me just say too, I've actually had a client that we've gone through the Divvy process with, and it ran smoothly. She found a house. The house was built in 2018, 5-bedroom home, 2-story in a very nice community that actually is still building homes in there. So the home is growing in equity. The amount that she will purchase her home back, because in her situation, without going too, in depth with her personal situation, but she was one, Divvy worked for her because she had just changed jobs. So she had the finances, she had the credit. But she needed that 2 years on her job for her to be able to buy it traditionally. And she was just sick and tired of renting. So we went the Divvy route. And when she gets ready, the buyback amount that Divvy gave her, it will probably, if the market continues to go in the direction it's going in, she probably will purchase her home with equity. And also, again, too, like you said, that she's able to save money as she's going through the process. So it was, and we were able to close in 2 weeks because Divvy is purchasing a home through cash. So with that being said, we'll go into just questions that we had some clients that asked us.
So
with that being said, we'll go into just questions that.
So my question is, I would say the first step in getting started with Divvy is to reach out to a realtor. Okay, reach out to a realtor such as myself and Dayna. But from there, when they fill out the application, what can they expect? We know right off the top that you're going to check their credit, but is it a hard credit pool or is it a soft credit pool? Because I have a lot of people, they may not be quite ready for that hard pull because they feel like their credit is already low and they don't want to get denied and have their credit dinged anymore. So what can you say about that? Credit is already low and they don't want to get denied.
Sure. So yeah, happy to speak to some of the requirements and just making sure that there's kind of an expectation set of communication between, your team as a realtor, but also with our clients, what they can expect from the Divvy team in terms of communication. And so when a client begins their application process with Divvy, they can expect first to receive a pre-qualification. That pre-qualification is going to be based off of a soft credit check. So to the point around credit checks, we only run soft credit checks. The only time when we would ever run a hard check is if we can't populate someone's credit. So for example, some folks will have a lock or a hold on their credit just for security reasons. In those cases, we can have the client remove that hold so that we can still pull the soft check. But really, to your point, our goal is to really help clients as opposed to hurt them. So running that soft check is really critical on our side, just in terms of making sure that we are populating the best credit score possible and that we're not affecting our clients financially just from the get-go off of a pre-qualification. So the pre-qualification uses that soft credit check. From there, we are going to ask our client to self-report their income in terms of qualifying with a healthy income. We typically expect that individuals will have at least between $25,000 to $3,000 monthly on their own. And then if you have co-applicants, I would say the more the better. One thing to keep in mind right now is really to think about the state of the market, right? And kind of what we can expect in terms of budgeting. And so, if you have a co-applicant, if 2 of you can qualify together, it's going to give you a lot more opportunity just based on the possibility and the potential of the types of homes that are available on the market right now. So in terms of income, that's typically where we're landing, somewhere around that 3K. And sorry, let me mute that. In terms of income, that's typically where we're landing, somewhere around that 3K. So the other piece that you'll want to—
So I'm sorry, there's, we have our delay in there, but I just wanted to clarify, it's $2,500 to $3,000 a month, correct, for income? Okay.
Yes.
And
that's minimum, right?
That's a minimum, correct.
Yes.
So what we're looking at is typically that $25,000 to $3,000 a month minimum per applicant. And then other things to keep in mind are going to be debt to income ratios. This is, really critical too, in terms of being able to qualify for a budget that would actually work for you, but also a budget that would get you into a home that is, likable and something that is on your terms. And so, for example, we'll want to see that you have at max a 50% DTI, and we'll make sure that you guys are really in a position to afford the pricing that Divvy has. So I think one piece that I like to emphasize is that, if you are making somewhere around the $2,500 to $3,000, you have, a bit of debt, you'll want to keep in mind that it's potentially for the best if we're not able to give you a higher budget, just based off of making sure that you guys are not being put in a situation where from month to month, you're not able to meet those minimum requirements and those budgets. And so really, I think it's a great opportunity if you are in a position to qualify based off of those beginning credentials.
Okay, so with that being said, it's a couple of things that, and we're going to circle back because it was a couple of things I think we need to go back and have a conversation about. It's like the DTI, what contributes to the DTI, because we had somebody ask about student loans, but I do want to get to, I see Nicole has a question on here. She's asking, what is the down payment requirements? And I will say before you answer that question, keep in mind that you're leasing, so it's not necessarily a down payment. But a deposit, it will not become technically a down payment until you are in the process of purchasing the home from Divvy. But if you can speak to that, Marlene, what do they have to look forward to in regards to the deposit amount?
Yeah. So in terms of deposits, there are some upfront costs that you'll want to keep in mind. The application itself is free, so nothing upfront in terms of starting with the program. When you do get fully approved, you start home shopping and you find a home that you like, you guys want to make an offer. At that point, we do require a $500 earnest money deposit. That's a good faith deposit that Divvy covers the additional portion of, being that we're going to be the buyer on that. That $500 actually goes into your savings and counts towards a portion of the deposit. And so that's what we would expect when you're ready to make an offer. If you have an offer accepted, if we are going to start moving towards a close, this is going to be your home, we're going to require for all of our clients to pay a 1% to 2% down payment. And this is a deposit that goes back into your savings. So Divvy keeps an equity building account for all of our clients. That's where all of your monthly savings go, as well as that $500 earnest money deposit and that initial down payment that you would make of 1% to 2%. So those are savings deposits that go back to you at the end of your lease term. And then lastly, the other upfront costs you'll want to keep in mind before we close on a home and before you can move is going to be your first month's rent. And that'll get prorated out so that you're not paying, double amounts of rent over the course of, a month or a month and a half that you've moved into the home. But those are going to be the three pieces you'll want to keep in mind that you'll want to be ready to come forward with in terms of the money. It'll be your 1% to 2% down, the $500 earnest money deposit, and your first month's rent. 2%.
Okay, so just to recap, it's no application fee, but it is a $500 deposit, like an earnest money in typical, or it would go towards the earnest money that Divvy would actually be paying, but that would also be contributed towards your deposit that you will pay as well.
So I'm glad you said that, because I had one of our clients ask. They thought that Divvy was costly because they did research on their own and they felt like that it was almost double the mortgage, which, that wasn't the case, because actually a lot of that money is being saved on your own behalf. So my question now is, how do you come up with the lease amount that's separate from the amount that would be, saved on your behalf for a down payment?
Yes, totally. And great question. I think, a couple of things to keep in mind is that we are comparable to market rent. I think one thing to keep in mind for clients is that we're talking about a lease structure that is leading to a purchase. So in comparison of what you might see in a mortgage versus what you're going to see in rent, those numbers are going to be very different. And so if you think about it, Divvy is charging for a month-to-month lease all the way through the 3-year period. One thing that I really like to emphasize is that, yes, sometimes the numbers might look a little bit larger or bigger than what you're seeing on a typical rent. But I think the things to keep in mind is that a portion of that is actually savings that we're setting aside for you. And the other piece that I think is important to keep in mind is that Divvy serves as a service as well. We're purchasing homes on behalf of our clients. And I think in any sensible business position, you would realize that there is like a bit of a service fee. So I would say like that's how I like to position it and be really upfront and forward that like, yes, you might see a slightly larger number in comparison to what you might pay on a typical rental, and certainly more than you probably pay on a mortgage. But we are talking about a rental, and we are talking about the fact that there is a bit of a service fee and there's a savings component to every one of the monthly payments.
Thank you for clarifying that, and to your point exactly, like sometimes when we are in these unique situations, it does cost a little bit more. But I will say from just dealing with the client that we did a Divvy purchase, that it was not astronomically, above for the amount of home that she got. I mean, it was right in alignment to probably what she would be paying for lease, maybe a little bit more, but then also keeping in mind that a portion of that is going towards the contribution of her being able to purchase it back.
So from what we're seeing, the required credit score is only 550, right? So with that being said, I've had clients who apply with Divvy and they believe that they have a 550, but they still got denied and wasn't quite sure why. Is there anything that you can say about that?
Yeah, I'm happy to speak to that. So yes, I think like the hard numbers, we're looking at a 550 minimum credit score across 3 different credit scores. And so something that I often get into conversation with is around those credit scores specifically, because as you guys know, there's a handful of different types of credit score numbers that you can expect to see for any person. Each of us has, one number that we probably associate to our bank, like one of our bank apps, or if you have like a savings account, those apps will give you a single number. However, Divvy is considering 3 different scores. We're looking at the FICO 2 score, a FICO 8 score, and we're also looking at a Vantage 4 score. And so these numbers are going to be atypical to what, the traditional consumer number that we're all used to seeing. And so one thing to keep in mind with that is that, the number that you may know through your bank, through another application or website that you're using may be a little bit different from the numbers that we're specifically pulling, just because they're not as traditional. They're calculated a little bit more differently, and they're way more specific to moving towards a rental or a loan. So for that reason, I definitely have had situations where clients are like, I have, a 580, like, why am I not qualifying? It's probably because one of these numbers had fallen below that 550. So that's really important to keep in mind too. One thing that I'll also add on top of that is that Divvy is also very mindful of whether or not there are charge-offs. If there's other information on your credit that would lead us to believe that maybe you do not have sufficient credit, that would also be a reason why a client could get declined based off of their credit scores. So I would say meeting that 550 across the 3 scores, as well as having just positive credit history and sufficient history, is going to be really key in moving forward in that pre-qualification and at least qualifying via your credit scores.
Okay, so that leads into the next question that we have, which is, if someone gets denied, how long can they do they have to wait before they can reapply, or is there a wait time in between?
Sure. Great question. There is a 30-day wait. This is also just very much dependent on the reason for decline. So if for some reason your client was declined based off of information that they believe was incorrect, potentially they didn't report enough income and that resulted in a decline. If they for some reason, if their credit scores they believe were incorrect and they were recently boosted, these are reasons why we can reset an application ahead of that 30-day period and have the client reapply. So typically it is a 30-day wait period. And that's usually a pretty healthy amount of time, especially when we're talking about a pre-qualification. If a client, let's say, is at a 540 or a 545, that gives them time to potentially work on those last few points of credit. So whether it's paying off a bit of debt, whether it's just making those on-time payments, that can be pretty significant in boosting that credit score to move it into a range that would help them qualify for Divvy.
Thank you. So with that, I'm going to kind of mix in a little bit. I see Crystal's question is, can someone give a guesstimate amount of how much the rent would be for someone? So is there a way in which, and I know for sure I can somewhat answer the question of, it all depends on the house. If you get a $300,000 house, your rent is going to be one amount versus if you get a $150,000 house. But is there a formula or a way that Divvy goes about to kind of come up with this estimate of the amount of the rent?
Sure. So yes to both questions. I think there's a couple of different ways that we can think about it. And to your point, Dayna, that's exactly right. If you think about it in terms of the house that you're looking at versus how much you're going to pay on that house, let's say a $300,000 house, the monthly budget range that you might be in to qualify for that amount of home is probably going to be somewhere in like the $28,000 to $3,100 monthly payment range. And that's, again, just an estimate. It can definitely vary. It can be a little bit lower. It can be a little bit higher. But in terms of that type of home and that range of home price, that's typically where you're going to land, at least above the $2,500 range. Now, in terms of how we actually budget out approvals, and I think this is something really important to focus on, is the monthly budget that Divvy can give you and approve you for is also going to depend on the types of homes that you can look at and the home ranges that you can look at. So let's say, for example, as Dayna mentioned, if you're looking at a payment of $1,500 to, let's say, $1,900 monthly, that will probably put you in a home range of closer to somewhere between 170 to 200,000. And that is, going to be very much dependent, again, on what you get approved for. Now, if we talk about the actual calculations that we're using to come up with those budgets, it's, again, going to be very dependent on your credit score and your debt. And so what we're doing is essentially, for all clients who are above a 590 credit score, we are going to take their monthly income. And if you have a co-applicant, we'll take both applicants' monthly incomes. We'll divide it out by 2. So that's to say a 50% DTI. And then from there, we're going to subtract out the monthly debt calculations that we have for that individual. So that will result in their budget. Similarly, we're going to do the same thing for all of our clients who are below a 590. However, what we're doing is going to then take the incomes and divide them by 3. So that's going to give us that 33% DTI. And then we'll subtract out the debts. And so what you can expect if you have below a 590 is that because of that DTI calculation that we're doing for you, you will likely have a slightly smaller budget, which is why we, really want to consider any additional income, any additional co-buyer. And then from there, you'll be able to look at homes within the budget range that you're approved for.
So that's some good information, and I appreciate that. But I was previously asked, what if some of our clients are self-employed? They don't necessarily have a W-2. They're kind of fearful of, will they be able to proceed with Divvy or not? What do you have to say about that?
Yeah, great question. And really important to emphasize. Divvy really tries to open the door for all types of clients. So we definitely work with W-2 clients. We work with self-employed clients and independent contractors. And we also try to factor in as much income as possible, honestly, for all of our clients. So if there's alimony, if there's child support, if there are, VA awards that are being given to you on a monthly basis, all of that is really important for you guys to report to us so that we can give you as high of a budget as possible so that you're comfortable with the types of homes that you're looking at and the budget that you're receiving. So really, when it comes to the different forms of employment, sometimes we come across folks who are employed and it's more so like a cash business. And even in those cases, so long as we can build paper trails to those deposits into their bank accounts and can review that to make sure that it's a stable taxable income over 3 months, we're able to add that in as a form of income. And so, like I said, I think we're really trying to do as much as possible to include those incomes so that there is an opportunity for folks who might otherwise, not have the opportunity because they're self-employed or because they're independent contractors. There is an opportunity.
Okay. It's so much that I would like to just expound on that too before I can go to my next question. Just as a reminder, keeping people in the mindset of you're going through Divvy as an alternative way to purchase a home. So even though everything may not be in order, just still going into it with the mindset of purchasing a home. So making sure your debt to income ratio, that you have a plan to get your debt to income ratio stable to where it needs to be. Even though Divvy's coming in at 50%, most lenders now are asking for 47, 42%, which means that you have to either decrease the debt or increase your income. So whichever one that you can do within that time frame that you're with Divvy. Also getting those credit scores where they need to be, as well. So not trying to come in, Divvy gives you the alternative to be able to get into the house that you want while you get those things in order, but still keeping in the mindset of I'm purchasing a home. The home that I'm going into, this is a home that I want to purchase. But I want to ask a question. I've had some people to go in and they've gotten approved or pre-approved through Divvy, but that number is not where they want it to be. They would like to be at a higher buying range. What are some things that they can do, or if there is anything they can do to increase that amount before we actually go home shopping?
Totally. Yeah, and I think we've kind of touched very lightly on some of those points already. So, things that you can do to increase your budget. I think number one, kind of like we mentioned at the beginning, having a co-buyer is really going to be super helpful in increasing a budget. Obviously, if you have two incomes, that's going to essentially double whatever you've been pre-qualified for. Additionally, other options, I would say if you have a little bit more bandwidth in terms of time and timeline, the option of potentially increasing your credit scores as quickly as possible, I think is a really great way to do that. If you are below that 590, I can't, stress enough how meaningful it is to be able to boost above the 590 so that we can, do a different calculation for you and essentially add hundreds of dollars back into what that budget could look like for you. So I think increasing credit score above 590, if you're below the 590, is really critical. Other options, again, is going to be adding in any additional income. So, you added your job, but is there other forms of income that you're receiving on a monthly basis that Divvy can consider? That'll be important. And then one that I think is really helpful too, well, I guess these are kind of twofold, is essentially if you have additional cash that you would like to put forward. Let's say you have significant savings at the moment. I think one way that you can use those savings to begin with is potentially paying down a little bit of debt so that A is going to increase your credit score at least a few points. Maybe it's not going to be enough to move you above that 590, but increasing that credit score is always going to be essential. And to Dayna's point, you're working towards being ready to purchase the home back. So anything you can do to kind of work yourselves in that direction is going to be meaningful. But second, paying down debt is also going to add any dollar amounts that you paid down back into your budget. And so that is one additional way that, let's say, if you have one thing that you're paying off and you can pay it off clean, that is going to be significant in being able to add money back into your budget. And lastly, I would say one that a lot of people do consider once they've already started the Divvy process is actually taking any savings that you do have and using it potentially towards a higher down payment. And so all of that money anyway is going back to you as savings. Those down payments always go back to you and go into your equity building account with Divvy. But what you're doing is essentially adding in increments of money in order to keep you within your budget range. So let's say, for example, there's a home for $350,000 that you're interested in, but you were only approved for a home that is, somewhere in the 320 range. based on your monthly budget, we can calculate out for you how much more down payment we would need to put you in that higher range. And so that's another, kind of nuanced option that we have internally, and that really, like, your advisor team is amazing at being able to give you those numbers. So when you get fully approved with Divvy, I would be, for example, working with Dayna. And then from there, we would expect that you're going to be working with our advisor team, who are very specifically dedicated to the numbers, to calculations, to properties. And they are the ones that kind of add guidance around how you can increase your budget. Does it make sense? Is it financially reasonable for you to be able to make these payments on a monthly basis? Or are we kind of shooting for the stars, adding in additional income when maybe, a $3,100 monthly rent doesn't necessarily fit your budget and is not necessarily something that you're comfortable with doing. So the advisor team is really a wonderful resource too, that I think all of our clients find super helpful once they're fully approved.
So I just had a clarifying question with that. I did hear you say that you can. So I get my pre-approval, and I'm going to use a realistic number that I've seen from someone. I get a pre-approval for $170,000.
Mm-hmm.
I can, but I want to get to at least $200,000. My purchase price of $200,000. I can go in and say that I have a savings where I can put in an additional amount of money to raise that buying power. Is that correct?
That's right. So you could contribute an additional amount to the down payment to get you incrementally closer to that $200,000 range. And so the one caveat that you might want to keep in mind is that in Texas, we actually have a limit of allowing clients to add up to 10% in down payment. So let's say, you have a client who traditionally would have the 2% option with Divvy. They would go ahead and add in up to 10% total down payment in order to get them into that higher, tier of home purchase price. But essentially, yeah, you want to think of it as almost like a scale. If you're here, you're adding in more money to get you to that purchase price, you're going to move this part of the scale forward until you hit that home purchase price that you're looking for.
Okay. I'm sorry. One more clarifying question to that. So let's say I applied, I'm at that 170. I don't have the extra money on there, but I only put in my W-2 finances. But I also have a side job that I do. I have other income. So once I've gotten that 170, I'm like, I do not want this 170. I want at least $200,000. Is there a way for me to go back in and add additional financials so that I can bump that number up to 200?
Yep, that's exactly right, Dayna. Great question. Yes. So at that point, you have that side job, you have additional income that you make on a monthly basis that is unreported via W-2, but is obviously a form of income that you report otherwise. Yes, you can absolutely add that in. Typically in those cases when we're seeing like self-employment or side jobs or independent contractor jobs, we're typically looking at bank statements. So what I like to say is, as long as we can build a paper trail to your form of income, we can add it in for a Divvy to review and add into your budget.
Great. So here's my question, and I'm pretty sure we got a lot of people out there wondering this. Let's say we apply, everything is good, the numbers are right, we find the house that we want to be in, we're happy, everything is going swell. So what happens if somebody misses a payment or changes their mind and decides not to move forward with Divvy, yet they paid the extra money above the lease price? What happens to that, and what happens to the contract? Like, in general, what happens?
Yes, great question. So if you are, in your home for a year and you're like, you know what, this is turning out to be not what I wanted. I need to move. Like, I have a bigger family now. I had a kid. I have dog. Whatever the reason is, if it's not working, that's okay. Divvy, I think, also is really understanding of the fact that, like, it's a lease to own option, right? And so we're really giving the flexibility of potentially buying back and then potentially not buying back. So what I would say is really wonderful about Divvy is that we do have the option for you guys to leave that lease, whenever you need to, even if it's a month in, 2 months in. I think the one thing to keep in mind is that Divvy essentially at that point will treat your initial 2% down payment as a security fee. So like, let's say you're leaving the home, you'll take everything else that you have saved with Divvy with you minus your initial 2%. And so that's one thing to keep in mind. However, we don't report leaving, the lease as a broken lease. We don't, we want you guys to be able to move forward and move into another home if that's what you were looking to do. But in those cases, we try to be as flexible as possible. But the one thing to keep in mind and that I'm super upfront about is that in leaving, whether it's 1 year in, 2 years in, or at the 3-year period, the only thing that you would not take with you from your savings is going to be your initial 2% down payment. Everything else, the monthly savings that you've built over that time goes with you. And to the point around adding additional down payment. So let's say you added more money up front so that you could get into the home that you wanted. We would only keep the 2%. If you added, 5%, 6, 7%, you would keep the remainder of that. We would just keep that initial 2% down. And we use that as a relisting fee. And I liken it to like a security deposit that you would not get back for having left the home.
Down. That's really great information and great to hear. One thing that I take from it is Divvy is really trying to put things in place to make sure that you are helping people to purchase homes and not, hurting the process. My question, you have a question? I'm sorry.
I have a lot of questions because I know people watching and I know they want to know. So let me ask you this. What type of home can our clients choose? Can it be like an investment home that like a fixer upper, a mobile home? Can it be a manufactured home? Can it be just an older home? Like, can you talk to us a little bit about what's the criteria for the type of home that you would accept?
Great question. So essentially you want to think about it this way. We're looking for move-in ready homes that you as a client, you want to own it, right? Like this is a home that you have invested in. This is a home that you put all this work into to get into it and to eventually buy it back. We want it to be a home that our clients love and they want to buy back. And that's really the goal of Divvy's program, is to give clients that option of a dream home. So with that being said, there are limitations to what we're able to purchase. I think when we think about like an investor home or a flipper type of home, it's very difficult for us to also expect our clients who are already in this position of, potentially not qualifying for a mortgage or really just trying to build up to that home ownership potential. We're not going to be able to purchase homes that are fixer-uppers, homes that need to be flipped. We cannot purchase investment properties. Additionally, things to keep in mind is that we can't purchase mobile homes or modular or like manufactured homes. Those are, typically not going to be the homes that our clients want to purchase back from us for the most part. So we keep in mind that like it really has to be a home that your client will love and also is just essentially like ready to move in. To your point around older homes, we don't have a problem with older homes unless, like, again, we're talking about homes that need a lot of work, that they are worn down. If they have a lot of maintenance issues, those homes would not work. But if you have, let's say, an older home, but it has really healthy systems, like the air conditioning and all the heating, everything in it is in really good condition or has been renovated, we're totally okay with that. I think the thing to keep in mind is that this is a property that we would expect the client to love and buy back, and that we're gonna do what's in their best interest as well as in our company's best interest to buy a home that is going to be reasonable for both parties.
So I know Roland asked about older homes, but I do want to throw out there to everyone, and correct me if I'm wrong, but I think I am not when I say this. You can purchase a new build as long as the HOAs, it doesn't have any stipulations on leasing. Is that correct?
That's exactly right. And so we do new builds actually a lot more often now than we had in the past. I think, to my earlier point around the state of the market and just the home inventory that's available right now, there's a lot of new homes that are coming on the market, and less so older homes that are becoming available for our clients to buy. So yeah, we work with builders all the time. It's actually way more frequent now, especially in Texas. We're seeing this happen a lot more, where our clients want to work with new builds. The only requirements around that is that they are ready within 90 days of closing. So typically you have to be very, very close to that completion stage with the home. And then other things to keep in mind in this case are that we do require the client to put forward the full amount of the earnest money deposit that is required from the builder. So that's to say it's a little bit different from what we do on a traditional sell, because typically we only require $500 from our clients for that earnest money deposit. However, I think a lot of builders sometimes only require $100, $200, nothing much more than that 500 to be able to move forward. But those are a couple of the nuances to new builds. But otherwise, it's essentially the same process. And we've, closed on several homes at this point that have been new builds.
This a new build? So a clarifying question with that. So if it is, so let's say, Divvy, we know the Divvy asks for a $500 earnest. But if the builder only asks for, or if the builder, I've seen some builders ask for $1,000. I'm just going to go worst case scenario, $1,000. So if they ask for $1,000, that is not in addition to the 500, or does that $1,000 that covers that 500?
That $1,000 covers the full amount of the earnest money deposit. Yeah, and that is really just because with new builds especially, we want our clients to feel attached and like they have some skin in the game in terms of being able to purchase this home back. So a new build is a lot to take on for Divvy too, just being that it is a completely brand new home. So we do expect that from the client. But to your point, Dayna, it does cover that earnest money deposit that Divvy otherwise requires. We would be covering that through that $1,000.
All right, I think Roland has a question. I don't want to overstep and and hog up the time.
So we know that when our clients purchase the house, or when they pick the house out that they want, and Divvy purchases the house, whatever the price Divvy pays, let's just say it's $200,000. That is not the price that the client is going to pay when they buy the house back from Divvy. Obviously, you're going to mark it up. So can you tell me a little bit about how much they can expect you to mark it up? And what if they don't, what if they miraculously, they're able to buy the house back in maybe 3 to 4 months? Would that markup still apply at that rate?
Yes. So great question. In terms of the buybacks, that's exactly right. So Divvy, let's say, buys the home for $200,000 for a client. What you agree to before we even get to that point is going to be very straight up terms on what the purchase prices will be down the road. And so we're really transparent about it. We don't change it. We're obligated to give you these options up front and never change them. So they're locked in once you start a lease. But what you can expect is that Divvy is going to take our initial purchase price and then add on anywhere between a 5 to 7% appreciation to both the 18-month pricing, so that's a year and a half into the lease, and the 3-year pricing, so all the way at the end of that 3-year period that you're leasing the home from Divvy. And so this is really, to Roland's point, we're talking about a home that in 3 years more than likely has appreciated. What we're doing in this case is really trying to limit how much we expect a home to appreciate. And so again, like, thinking about our clients' financials and the possibilities of our clients buying this home back, we don't want to put them in a position where we bought the home at $200,000 and now the home is appreciated to, $100,000 above what we purchased for. Like, we don't want to be limiting that potential for our clients. So we cap all of our appreciation at 7% in all of our metros, which is really helpful, especially when we look at inflation and we look at the numbers of how homes are can appreciate over time. I think conversely, the other side of that is thinking about the potential of a home not necessarily appraising to the amount that Divvy is offering as the purchase prices. And so this is obviously kind of the same gamble that you take when you're buying a home anyway, is the potential for a home not to appreciate at a rate that's expected. But for that same reason, we have that cap on the appreciation to keep it relatively low, so that even in those situations where there may potentially be a lower appreciation rate, we're going to make sure that your clients are not being out, hundreds of thousands of dollars just because the home did not appreciate at that rate. And so to kind of talk about the actual numbers, let's say, for example, a home that's $200,000 up front, that's what we pay. In a year and a half, at that 18-month period, you can expect the home to be somewhere closer to 215,000 to 25,000. And then at the end of that 3-year period, you can expect the home to be closer to 220 to 230 in terms of what we've added on as appreciation and what you would be paying when you want to go and purchase that home back.
Yeah, and I was going to hit on that a little bit, because if you're charging 7% markup on a $200,000 house, yes, that is around $215,000. And what we're seeing in this current market, we're seeing a $15,000 appreciation in a matter of months, like 3-4 months. So let's just say you need to go the whole 3 years. I mean, if you bought that house if Divvy bought the house for you at like 200, and they say you got to pay 215, and if you go to 3 years, that house could easily be 230, 240. Now that's speculation, but I'm just saying historically, the way the market is going now, that's what we're seeing.
Yes. Yeah. And one thing that I would add to that, you asked this question too, was what happens if you want to buy the home back, 3 or 4 months in, 6 months in. So the way that Divvy calculates that out for you is that you would still be tied to the 18-month pricing. So anytime between the beginning of your lease all the way through the 18-month period, you're going to be purchasing the home back at that 18-month pricing. It's not prorated or anything like that, so you are locked to that price. However, there's no expectation that a client would pay, any amount of lease or the monthly payments in between, the purchase day and that 18-month pricing. All of that kind of goes out the window. All we expect is that the client is going to pay that buyback price. So, I think if there are clients who are thinking about that, I would say don't worry about the fact that you're buying out early. We're not going to expect you to pay, that amount in between the buyback and the decision to purchase the home.
Okay, so I'm going to wrap up probably with one of the last questions. If Roland has another question, and then we're going to bring it to an end. But one of the questions that I've been asked many times is about student loans. We know that now student loans are being looked at a little bit differently, or calculated a little bit differently with DTI for regular lending. It's at 0.5% versus the 1% of the amount of the student loan. Is there any difference in how Divvy is calculating student loans as it pertains to DTI and pre-approval?
Sure. Great question. So right now, being that most student loans, or at least government loans for students, are going to be in forbearance, we're actually not counting student loans at the moment. So if you are in that position right now, I would say it's a really great time to apply, because those loans are not being counted. Now, for all other student loans, private loans will be accounted for on the minimum monthly payment that is required from the lender. And so let's say, you have a student loan that is $20,000, and you have, whatever percentage of interest on that loan. We're not looking at those numbers. What we're looking at is going to be the minimum amount required for you to pay out to that lender. So in that case, it really, I think, helps out the client in that we're counting it as a debt, and I think it is easier for us to count it as like a lower amount of the actual payment that goes into that loan on, an interest-based interest-based amount. So I would say right now, in terms of the way that we're calculating out the student loans, they will be counted. But I think the positive to that is going to be that we're really only counting those minimum monthly payments and not necessarily counting anything based off of interest and the full, as my example, $20,000 that you owe on that loan.
So that's really good information. So to those of you all who have student loans, if you have government student loans, you need to hurry up, run now, and go and email Roland now so we can send you out a link so that you can apply for Divvy. That's not counted against you unless it is a private. And if it's private, it's only the minimum amount that you're paying monthly that goes to towards your debt to income. But real quick, I'm sorry, just a clarifying question with that one. Let's say I have a private student loan that I have to pay back and I am not paying anything on it. How is that if it's in deferment and I'm not paying anything on it right now? How is that then calculated?
Yes. So anything in deferment, we can account for that deferment so long as we have essentially the paperwork to prove it. And so even right now with those with the government student loans that are in forbearance or that they're in deferment based off of COVID and, for whatever reason that you may not be paying a loan, as long as we have documentation showing that you are not and essentially stating that you will not owe this amount for X amount of time, we can account for that. And our underwriting team is really great at finding, every way to put more money into your budget so that you qualify for more. So absolutely, if that's the case, we can take that paperwork and just account for it and, move that back into your budget.
All right. Really good information.
So does anybody have any questions? First of all, just go ahead and type them into the comments, type them anywhere on any one of our posts. We can see our notifications. While we have Miss Marlene here from Divvy, you can get some good, accurate information. So feel free to keep those questions coming for the next 2-3 minutes, maybe. But our phone numbers are at the bottom, 832-890-5400, and my wife's 713 phone number. Give us a call, text, email, inbox. We can get you going with Divvy and, on the way to home ownership, because you don't want to keep renting when you don't have to.
Yeah, and I just want to recap too with a lot of information that that Marlene gave in regards of why let me just say this. We do understand that this is not for everybody. But for those that it is definitely set up to help you. The fact that you are able to, you can cap, they're not coming out of the air with numbers. There is a calculated amount of how much they're going to go up on the amount for your buyback amounts. The way that the amount for what you put down for your deposit, how it's contributed back to you. Even the fact that if you decide to change your mind, that of course, there's an amount that you have to keep, just like you would if you were renting, otherwise from a regular landlord. But they're giving you the extra escrow amount that you're paying every month.
Yeah.
That's refunded back.
I was going to hit on that because, some of the people that I talked to, they were a little hesitant with the money that you're going to take that's above the lease. Like if the lease is $1,500, that's what it would be, but they have to pay $1,800. Everybody's a little hesitant with that. But if you truly plan on buying this house, you're going to have to be saving money anyway. Okay. You're going to have to be saving money anyway. And the one thing about it is, I guess you could say that Divvy helps you with discipline, because that extra $300 a month that you would need to be saving anyway, you actually have access to it. Okay. When when those new shoes come out, or you want to go to dinner somewhere nice, you have access to that money. I'm just saying. But with Divvy, you don't have access to it. They're going to hold it, and it's going to be in a safe space, and it's keeping you honest about your goals. So don't look at it as, oh, I got to pay this much extra. No, they're forcing you to save and do what you said you were going to do. So you should look at it that way.
And if Marlene, if you have anything extra to add, feel free to, let people know whatever, that there is to know about Divvy. And then we're going to conclude with you, and then we're going to go ahead and sign on off.
All right. Yeah, you guys. Well, I just want to say thanks again for having me. It's so great to be able to speak to you guys, but also just get in touch with our clients. I think that I don't get that opportunity all the time, so I'm really happy to have had it here. I would say for all of our clients, I think the team's totally right. I think it's not for everybody, but if it does work for you, and if it is for you, it really does give you an opportunity to be a little bit more disciplined, I guess, too, and to be able to build towards something that's going to be really meaningful down the line. It may not be your only home, your forever home, but it could be your first starter home, and really gets you, into the real estate industry that we don't all have the opportunity to do. And I think that's how I view it. It's a start. And if it's not the perfect home, the home that you are going to keep for the rest of your life, it at least lets you start somewhere, and you have that home that you can then, potentially sell and then move on to the next one. But I think getting your foot in the door is how I view it. And it's really a great opportunity if you are starting in a place where you just need to start. You need someone to help, and you need a team that can move you there. I think working with the Hennigan team, and also just working with Divvy, is a really great opportunity. And I just highly recommend it to those of you who are interested.
Thank you so much, Marlene, for coming on. So again, this is Marlene with Divvy. She is our representative for Divvy to come in and ask those questions that you guys may have had. And don't sign off, don't log off yet, Marlene. We're going to just say goodbye to everybody, but I want to just let's talk real quick before you sign off. All right. Thank you guys so much for tuning in to our Lunch and Learn about Divvy, and just coming in and asking your questions. This video will be able to be viewed after the recording on our Facebook page, Hennigan Realty, at Hennigan Realty Group. So feel free to watch it later if you guys had to, tune out a little early, or if you tuned in a little late, and then type in your questions at the bottom. Roland and I will be on there constantly looking throughout the days to see if you guys have any additional questions. But you can always contact us directly. Our numbers are at the bottom of the screen. You contact Roland directly at
832-890-5400.
Or you can contact me directly at 713-478-7443. Again, you can also visit our website, www.henniganrealty.com.
$500.
Yes, and thank you for reminding me. So also, if you don't know, now I'm getting ready to let you know that we also offer $500 towards your closing costs for anyone who works with Roland or myself. And then always look out, because we're always doing all kinds of different things where we are increasing that price. We just did it for teacher appreciation for $750, but always stay tuned. Push this information out. Contact us. Also, you can come to our workshop. You want to tell them about our workshop?
Yes, I was going to talk about that. So every third Saturday of the month, you can find us from 12 o'clock to 2 o'clock at the Shape Center in 3rd Ward. I don't have the address in front of me.
It's the one on Live Oak.
Yeah, but it's on Live Oak, the Shape Center. Every third Saturday of the month from 12 to 2, you can come, and we have a workshop. And it's not like where we sit around and preach and we talk to everybody. No, you talk to us one-on-one. You talk to us as realtors one-on-one. We send you to a lender to talk about your finances and what it's going to take to get you in a home. And you may need to talk to a credit person. We have all of that under one roof, okay? And you may leave without a clue. You may come in without a clue, but you're going to leave with a plan, a personalized plan to home ownership. Because why? You talk to the realtor, you talk to the mortgage lender, you talk to the credit person. We may have an inspector there, whoever needs, just whoever. But you're going to get some one-on-one information, and you'll be able to move with that. So come on out.
And you never know, you may walk away like some people. We've had a couple of people to actually leave out with a pre-approval letter in hand. So that is also possible. But what we always want you to know is we believe that there are different ways to home ownership. Everybody does not have the same route to home ownership. That is why we're bringing you Divvy, and we'll be bringing more programs to you guys. So stay tuned. We're going to be doing this on a regular basis, at least once a month.